Budget managers are required to provide support in financial reporting obligations at United Therapeutics. Understanding the basics of this type of accounting will help with your ability to support the organization. Accounting encompasses a broad spectrum of financial activities, and a significant facet within this realm is the management of liabilities. Liabilities are obligations to pay a third party for goods delivered or services rendered. These incurred expenses that have not yet been paid are also referred to as an accrual. United Therapeutics is required to report our outstanding liabilities to the SEC and shareholders each quarter, which is why we need to understand the importance of liabilities and correct processes surrounding them. Take Bob, for example. Bob mows the lawn at UT every month for an agreed-upon price of $100,000. Fran works at UT in FP&A, and as part of the quarter-end activities, she confirms with her friendly UT budget manager, Mac, that Bob has mowed the lawn this month, but will not be sending an invoice until the following month. Since Bob's invoice will not be paid until the following month, Fran needs to set aside this money as an accrued liability. Bob is just one example of the types of vendors that Fran needs to accrue liabilities for as part of her quarterly activities. As part of her job, Fran needs to look at all the open POs that UT has and determine any other potential liabilities. Because UT has hundreds of POs open at any given time, the UT budget manager is key in providing information to determine the estimate of all the unpaid expenses for goods or services. This can be in the form of change orders that have not been reflected on a PO yet, but the services have been provided by the vendor. Liabilities are just one portion that make up the vast field of accounting. Bob has been doing such a wonderful job with the lawn maintenance that UT decides to hire his cousin, Rob, to run some radio ads for UT. Rob works a bit differently than Bob and wants payment for all 10 ads he plans on running once his contract is signed. UT has agreed to pay $500,000 upfront for the 10 ads that will air through the course of the year. This payment for services that have not yet been rendered from Rob is a prepaid asset. Prepaid assets are advances in funding to secure future services or goods from a third party. This may include allowable upfront payments for services, deposits on equipment or materials, or advances to cover travel. And just like our liabilities, United Therapeutics is required to report our prepaid balances to the SEC and shareholders each quarter. And just like before, Fran needs help from Mac, so she can make sure she is recording all the prepaid assets correctly at the end of the quarter. Now that we understand liabilities and prepaid assets and the important role that UT budget managers have, we can look at another element in the field of accounting: fixed assets. Fixed assets are long-term assets that a company uses in its operations, such as property, plant, or equipment. They have a useful life of more than 1 year and a value greater than $5,000. For example, UT buys a piece of equipment called the Widget Sorter 3000. This equipment is a fixed asset because it will be used for more than 1 year and costs $25,000. Fixed assets are also called capital assets or non-current assets. Budget managers need to understand fixed assets so that they can update accounting if these assets are still in use or have been disposed of. Understanding these intricate components of accounting, from accrued liabilities to prepaid assets and fixed assets, is essential for budget managers at United Therapeutics to support as good financial stewards.